Welcome to another episode of Market Brief After Hours. It has been a fascinating, record-breaking week on Wall Street, but Friday brought a bit of a reality check. We saw the major indices slide into the red to close out the week, even though the broader picture still shows some solid weekly gains. Let's start with the big picture. What exactly happened on Friday, and how did the major U.S. indices wrap up the week?
It was definitely a day of digestion for the markets. After hitting some incredible heights earlier in the week, we saw a modest pullback on Friday. The S&P 500 slid 0.2% to close at 7,786. Meanwhile, the tech-heavy Nasdaq composite shed 0.3%, ending the day at 26,729. The Dow Jones Industrial Average also slipped by about 108 points, which is a 0.2% decline, closing at 53,732. But if we step back and look at the weekly performance, the narrative is still quite positive for most of the market. Both the S&P 500 and the Nasdaq managed to notch their third consecutive weekly advance. For the week, the S&P 500 was up 0.4%, and the Nasdaq eked out a 0.1% gain. The Dow, however, lagged behind, closing the week down 0.6%.
It's worth noting that before Friday's slip, we saw some historic milestones. The S&P 500 actually crossed the 7,800 threshold for the very first time on Thursday, hitting an all-time intraday high of 7,816.70. What was driving that optimism earlier in the week, and why did the momentum stall on Friday?
The early week rally was heavily fueled by subdued inflation readings on Wednesday and Thursday. Those numbers gave investors hope that the Federal Reserve might finally be done with its rate hiking cycle. But by Friday, that optimism faced some resistance. Analysts are pointing out that we are entering a post-earnings flattening out trade, with more than 90% of S&P 500 companies having already reported their second quarter results. The market has mostly priced in the good news. And the news was indeed good. Earnings growth from the year-earlier period is currently tracking at around 50%, according to FactSet. But once that earnings engine slows down, the market naturally starts to digest those gains. If earnings growth holds at these levels, oil stays above $80, and the Fed keeps rates steady, there are still projections that the S&P 500 could reach 8,100 by the end of the year.
That's a very encouraging year-end target. Interestingly, while the large-cap indices pulled back, small caps seemed to have a great day. The Russell 2000 closed in the green for the fourth consecutive session.
Yes, the Russell 2000 was a bright spot on Friday, finishing up 0.5% for the day and posting a solid 1.1% gain for the week. This marks its longest positive streak since late June. It shows that there is still some underlying rotation and appetite for smaller, domestic-focused companies, even as the mega-cap tech stocks take a breather.
Let's talk about the economic data that came out on Friday, because it painted a much more complicated picture of the U.S. consumer. We saw an unexpected drop in retail sales and a dip in consumer confidence. How concerning are these numbers?
They certainly raise some eyebrows. U.S. retail sales for July posted their first decline in 9 months, falling by 0.6%. Economists were actually expecting a modest increase of 0.1%. A major culprit was a 1.8% pullback in sales by motor vehicle and parts dealers, which is a sharp reversal from the 2.4% surge we saw in June. But even if you exclude auto sales, retail sales still dipped by 0.3%. Compounding that, the University of Michigan's preliminary August survey showed consumer sentiment falling to 51, down from 55.2 in July. That was also worse than the 54.5 reading economists expected. Plus, consumers' one-year inflation expectations ticked up slightly to 4.3%.
So we have a weakening consumer, but at the same time, inflation expectations are rising. How does the Federal Reserve interpret this?
It puts them in a delicate position. On one hand, softer economic data combined with flat producer prices in July should theoretically ease the pressure on the Fed to raise interest rates. On the other hand, economic weakness is a steep price to pay just to avoid another rate hike. The market has largely shrugged off rate concerns because corporate earnings have remained so resilient. But for the broader economy to stay resilient, the consumer ultimately has to keep spending. One bad month doesn't mean we are falling off a cliff, but it's getting harder to ignore when you look at it alongside softer GDP and jobs data.
And as if domestic economic data wasn't enough to worry about, geopolitical tensions in the Middle East are back in the spotlight, specifically around the Strait of Hormuz. How did this impact energy markets and Treasury yields on Friday?
Geopolitics definitely drove the action in the bond and energy markets.
Oil prices jumped on Friday after the U.S. warned that its naval blockade of Iranian ports could continue indefinitely. This came after reports that Iran attacked 2 commercial vessels in the Strait of Hormuz. Brent crude futures rose 1.7% to close at $88.52 per barrel, and U.S. West Texas Intermediate crude gained 1.4% to settle at $82.40. For the week, both benchmarks surged more than 5%. This geopolitical risk, combined with the U.S. Treasury Secretary's warnings of unprecedented measures to economically isolate Iran, pushed Treasury yields higher. The 10-year Treasury yield, which is the key benchmark for global borrowing, rose more than 5 basis points to 4.696%. The 2-year yield, which is highly sensitive to Fed policy, added 3 basis points to 4.171%, and the 30-year bond yield advanced to 5.267%.
It seems like a lot of moving parts for investors to navigate. We have much more to cover, including a deep dive into European and Asian markets, a look at some major currency moves, and our top stock movers of the day. But first, let's take a quick pause. Stay with us. Welcome back to Market Brief After Hours. Before the break, we focused heavily on the U.S. markets and the macroeconomic picture. Let's shift our gaze globally. European markets had a pretty choppy ride on Friday. How did they close?
European stocks ended the day with a mixed performance. The region was caught between relief over tame U.S. inflation data and anxiety over the Middle East conflict and the closure of the Strait of Hormuz. The Pan-European STOXX 600 shed 0.21%. Looking at individual countries, France's CAC 40 and the UK's FTSE 100 both dipped, losing 0.16% and 0.21% respectively. Switzerland's SMI also ended lower by 0.58%. However, Germany's DAX bucked the trend, outperforming the rest of Europe with a 0.53% gain. Did we get any fresh economic data out of Europe to give us a sense of how their economy is holding up?
Yes, we got the second estimates for Eurozone GDP, and the economy expanded by 0.4% in the second quarter of 2026. That is a nice acceleration from the flat growth we saw in the first quarter. Spain was the standout performer, with its GDP rising 0.7%. The Netherlands also beat expectations, expanding by 0.4%. France returned to growth with a 0.2% increase, while Germany and Italy also managed 0.2% growth, which actually exceeded market expectations. On a year-over-year basis, Eurozone economic growth accelerated to 1%. However, inflation concerns are still lingering. German wholesale prices rose by 5.3% year-over-year in July. And in France, consumer price inflation accelerated to 2.1% in July, driven by higher energy and services costs. So, much like the US, Europe is dealing with a mix of steady growth and persistent price pressures.
Now, what about Asia? We saw some very divergent moves across the Asian markets on Friday.
Absolutely. In China, the Shanghai Composite fluctuated before finishing marginally higher at 3,927. But Hong Kong's Hang Seng Index fell 1.10%, hitting a 3-week low. China actually posted a record current account surplus of over $195 billion for the second quarter, but that was overshadowed by a surprise decline in new bank loans for July, which fell to a negative 340 billion yuan. In contrast, Japanese and South Korean markets had a great session. The Nikkei average climbed 0.59% amid reports that the Bank of Japan is eyeing a September rate hike, which the government apparently supports. Tech stocks like SoftBank Group rose 2.9% on expectations of sustained AI data center demand. But the real star of the region was South Korea's Kospi Index, which soared 2.42%.
That is a massive export surge for South Korea. Let's transition to the foreign exchange markets now, because we saw some significant technical breakouts on Friday. Let's start with the euro and the British pound.
The euro had a very strong showing. The EUR-USD pair rose 0.36% to close at 1.1569. What's technically significant here is that it broke just above its 100-day simple moving average, which sits at 1.1567. It is also trading well above its 50-day moving average of 1.1465. The next major structural resistance is the 200-day moving average at 1.1628. If it can hold above 1.1526, the bullish momentum remains intact. The British pound also extended its advance against the dollar.
GBP USD closed up 0.35% at 1.3533. It's currently trading comfortably above all its major moving averages, the 50-day at 1.3373, the 100-day at 1.3413, and the 200-day at 1.3412. This indicates a very robust and healthy uptrend, with the pair now testing its recent monthly highs.
And what about the commodity currencies, like the Australian and Canadian dollars?
The Australian dollar broke out of a multi-day consolidation, with AUD/USD rising 0.33% to close at 0.7082. It is constructively positioned above its 50-day, 100-day, and 200-day moving averages, which are at 0.6989, 0.7056, and 0.6933, respectively. This confirms a very strong underlying uptrend. On the flip side, the US dollar sold off sharply against the Canadian dollar. USD CAD fell 0.41% to close at 1.3872. It broke decisively below its 100-day moving average of 1.3918 and is now fast approaching its critical 200-day moving average at 1.3851. If it closes below that 200-day average, we could see a major structural breakdown for this pair.
Fascinating technical setups there. Let's look at precious metals. Gold and silver have been on a bit of a recovery path lately. Did that continue on Friday?
Yes, but they are hitting some key technical ceilings. Gold rose 0.60% to close at $4,376 per ounce. It is trading well above its 50-day moving average of $4,155, but it ran into resistance just below its 100-day moving average of $4,391 and its 200-day average of $4,488. So, while the short-term recovery is strong, it is still technically in a medium-term corrective phase. Silver also paused for breath, closing up 0.37% at $64.70. It remains comfortably above its 50-day moving average of $61.61, but like gold, it is still well below its 100-day and 200-day moving averages, which sit at $68.78 and $70.78. It looks like buyers are digesting recent gains before trying to push higher.
To wrap things up, let's look at some individual stock stories that made waves on Friday. There were some massive double-digit moves. Who were the big winners and losers?
The biggest winner of the day was Reddit. Its shares rallied more than 12% on the news that it will be added to the S&P 500 on August 18th. This is an off-cycle change because Avalon Bay Communities is being delisted due to its merger with Equity Residential. We also saw a major rally in Sandisk, which jumped over 7% after JP Morgan gave the chipmaker an overweight rating following its investor day. Another big theme on Friday was drone stocks. Shares of unmanned aircraft manufacturers surged after President Trump imposed import tariffs on foreign-made drones and parts. Unusual machines skyrocketed 25%. Notably, the president's son, Donald Trump Jr., joined their advisory board in 2024. Redcat also surged 9%, and AeroVironment jumped 2%. On the losing side, semiconductor and tech equipment giants took a hit. Broadcom and Applied Materials both fell more than 5%, weighing down the Nasdaq.
A highly active day to end a historic week. That is all for today's episode. If you find this useful, please follow Market Brief After Hours. Have a great weekend, and we will see you next week.